The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes, and we are really in the thick of it, 16 days, including tomorrow, before the end of tax season. April the 15th is approaching, and I know there are people that they're like ostriches. They got their heads in the sand and they're thinking, I don't want to know the answer to it. I've had many people this year that have come in and said, with all the changes in the tax law, we're so insecure and we just don't know what to think. And I will tell you, now is the time to get yourself ready. Tomorrow's supposed to be slushy and snowy. Great time to pull out those receipts. April the 15th is like not a good time because if there's something you need to get, like for instance, if there's no cost basis on a stock that was sold, you run out of time. So we want to help you. I'm Esther Gulius from EG Tax. We have 30 offices to serve you in the Western New York area. Our office is open tonight till 5 o'clock. Sunday, we have our McKinley Mall office that's open. That's the only one. The rest of us are just kind of dozing off and getting ready for Monday. The rest of the week, we're open 9 to 9, and we're here to help you. And I got Chris Fabian. Hey, Chris.
Hey, Esther.
We got you out of the studio, out of the office.
Yeah, and if you want to call us, don't call Esther's cell phone. Call us in studio at 803-0930.
That's right, 803-0930, 803-0930, star 930 on your cell phone. You can text us at 3930, and we will try to help you with whatever tax situation you had. Anything, have you had any really unusual situations?
I know, like you said, I have a lot of people coming in going, I'm going to owe. With everything being said, I know I'm going to owe. And when we're all done with the return, then they look and they go, are you sure you're right?
Yeah.
Because they have a refund coming.
Yeah.
Because everybody is different.
That's right.
You can't just go by what the news is saying or by what your friend is saying at work because you don't know their tax situation.
That's correct.
And
a lot of times people we told everybody in advance last year, this is what's going to happen, so you want to make sure you adjust your withholding. So, and then this year when they come in, they find out, it isn't as bad as they thought because they had adjusted their withholding. The trouble is many people need to tax plan. And I will tell you, when you're done with this year's return and you think, oh my gosh, I owe money, don't just put your head in the sand. You have to go back to your employer or change your estimates or have withholding on your Social Security because pretty much unless they modify the tax law this year, and as we know, they do that all the time, but right now we don't know of anything, you want to make sure that you've changed your W-4s at work so that you don't have the same thing happen next year because it will happen again.
Right?
Right?
Yep. I tell my clients, wait till the politicians get their taxes done,
and then
we'll
they'll
see.
know. Right. The other day I had this lovely lady that came in, and to tell you the truth, the last couple of years she's done her own return on TurboTax. So this year she comes in and she says, well, I told my ex-husband he could claim our daughter, but the daughter was in college. And I know this couple, and I said, well, do you have a 1098-T for your daughter? She said, no, we don't. We don't have it. So I was sure that the ex-husband didn't have the 1098-T and didn't take the education credit. But there was another daughter that he could have claimed who was 18. And I said, why don't you let him claim the 17-year-old daughter and you claim the 18-year-old daughter who's in college because you have about a $3,500 credit coming for education. And she said, well, I don't know anything about that. Well, what's happening is we're amending the ex-husband's return to change children. So he's going to get the same result as he had, but it's got to be an amended paper return where we have to do her return as paper to add the daughter that was claimed on the husband's. But the bottom line is she's going to come out around $3,000 to the good because the American Opportunity Tax Credit is a lot of money.
Yes.
And how often do you think people do it wrong?
Oh, all the time.
Yeah.
I'd say 50%.
Yep.
I know I had somebody this year new to us, and I'm looking at the daughter's 24, and I'm looking at their last year's return, and I still see the AOTC for her.
Oh, that's not good.
Yeah, and I'm like, how long has she
Did
been
she
in
skip
school?
school? Yeah.
Oh, no, she started right away, right from high school. I said, well, you have 2 years at least of mistakes on your tax return that the IRS, you will probably be getting letters. And they said, what? And they went back and, yep. So I said, when you get the letters, the IRS isn't going to switch it to the lifetime learning.
Right.
They're just going to bill you that $2,500.
Right.
So come in, switch it to the lifetime, and you'll owe $500.
Right.
So
Right.
they're like,
why
oh.
didn't you, and of course you can also
Always
you
do
would
the
offer
amended
to
now.
do
Yep.
the amended.
Yep.
But that's what happens. The American Opportunity Tax Credit is available for the first 4 years of higher education, whether it's college or if you're in a trade school, anything that would qualify for student loans assistance would mean that it qualifies for the American Opportunity Tax Credit. You can take a credit of up to $4,000 of the tuition paid, which would result in a $2,500 credit on the federal, $400 plus on New York State, plus you get the $500 family credit. So it's a lot of money. And so if your child has claimed themselves and they're living in your home in college, even if they borrowed money themselves, you can still fix it and get the money back, right?
Yep. Oh, yep.
By doing an amended return. Let's go to the phones. We're going to go Teresa. Hey, Teresa, how can we help you?
Oh, I was calling about the American Opportunity because when I did it, I thought last year when I did it, under the American Opportunity, I got for my daughter who went to college $2,500 and then $1,000 refundable. But this year it seems like they're only saying $1,500 American Opportunity and with $1,000 refundable.
Well, that's how it always was. The $1,000 is always been refundable. The entire credit is $2,500, but only $1,000 comes back if you have no tax liability. If it wiped out your tax, if you had no tax liability, the excess is $1,000 refundable.
Okay. All right. Thank you.
All right, Teresa. Let me ask you: may I ask what your income is this year from wages?
About 55,000.
55,000. So that doesn't seem like. I mean, it should have wiped out your tax liability plus the $1,000. So it shouldn't be any difference from last year. Maybe you just never noticed it before.
That's what I'm thinking. So you get the $1,500.
The $1,500 is going to reduce your tax liability. Okay.
Right.
Then what's left? You're going to get $1,000 as if you paid it in and withholding.
So it's really a total of $2,500.
It's a total of 25. And then on the state of New York, did you do the Empire State credit?
Yeah, and that was $400, right?
It's either $400 or if you do better by using it as an itemized deduction, you can do either or. But $400 is a safe bet. Yes.
Okay, great.
Okay.
Have a nice day.
Thanks, Teresa. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back with your calls on the other side. Hey, I'm Esther Gulius, the tax lady from EG Tax, and we're talking taxes. And let's face it, Bubba's, we only got 16 days till the end of tax season. I got to do my tax return. I was thinking about doing it tomorrow. Tomorrow sounds like a good day, don't you think?
Sure, go for
snow and everything. 8030930, 8030930, star 930 on a cell phone, and our phone number, our text number is 3930, and we got a text, Chris, right?
We do. It says, I filed my New York State return March 2nd. It was accepted, but the website still shows no payment due. I owe them $263. New York State won't take the payment until it shows I have a payment due. What do I do? I would give them another week. If they don't change it, I would mail them a check.
I'm going to tell you something. I would definitely, because they will penalize you if you don't make the payment. So with New York State, you have to really be proactive because you don't want them to penalize you, and they will.
Yep.
right?
Yep.
Okay, and again, we're talking about all kinds of things. We're talking about whatever subject you want, but we were talking originally about the American Opportunity Tax Credit, 529 plans, student loan interest, and scholarships. There's that kind of a thing too. But let's go to the phones. We're going to go to Paul, who's been waiting. Hi, Paul.
Hi, how you doing, Esther?
Good.
Good. Esther, my question is, my wife and I have our deduction set for 0 at a higher single rate.
Yep.
And I find it easier for the government to pay me than me to cut the money and pay them.
Mm-hmm.
And good thing I did it this year. Okay, what happened was last year we filed our taxes and we got back, well, a little over $4,000.
Okay.
This year we filed our taxes and nothing's really changed. And
Oh, yeah, a lot changed, but okay, go on.
well, nothing's really changed on our end.
On the
Right.
I got back $500 from the feds.
Yep.
I owe $400 to the state.
Yep.
Well, the state didn't change. The state should have been
The
very
state-
similar to last
The state
year.
withholding didn't change. But what happened last year with the change in the tax law was that they changed the withholding charts. So in 2018, you got more take-home pay every week, and many people didn't notice that they got an extra $30, $40, or $50. But you take $50 times 52 weeks, that's $2,700 that you didn't have sent in, that you got as an extra take-home pay, and that adjusted your tax liability. And that's what's happening this year. And so what you want to ask yourself, Paul, is that are you happy with the $500 refund? And if you are, because you have to understand, there's not too much extra money that's being sent into the IRS. So if you're happy with the $500 refund, that's where it would pretty much settle unless something unusual happens in your tax situation in the future. So if you're happy with the $500, great. If not, you got to go back to your payroll department and do 0 single plus an additional withholding.
Wow, because I'm doing 0 single now. Both of us, my wife and I are doing that. So I got to
See, but the thing is, Paul, I don't know your situation, but you might have investments, you might have rental property, you might have Social Security that isn't having taxes withheld. So just because you're having 0 single on your W-2 on your wages might cover that portion of your income, but you might have residual income that nothing's being withheld on. And they did modify the withholding charts in 18, and so you want to go back and either start doing estimates or have extra taken out if you want more.
And
of a refund.
if you want, bring in your return from 18 and 17, and we'll review it
we'll
and
show
see
you.
what's going on.
But if you just take a look at last year's, if you look at 17's tax liability and you look at 18's tax liability, I think you're going to find out that you are paying less taxes in 18 than 17. But then you look at your withholding and you see that your withholding is way off as well.
okay.
Okay?
They'll explain why a lot of my friends are complaining that they're owing a lot of money.
Oh, Paul, you have no idea. I have soft music playing in my office. My clients have suggested I put a bar in the back of the office to alleviate the pain. So believe me, I understand. And that's why with 16 days left, if you owe money and it comes as a great big shock, in your situation, you always got money back. If you find out you have $1,000 liability and this is not what you expected, you want to know in advance because getting the bill paid is so important.
Right.
Okay? Hey, thanks for calling.
Thank you very much.
Bye-bye, Paul.
You know, and we see this too, where people, I changed it. I put in a new W-4 to change my withholding, but they never checked their pay stub to see because maybe his withholding never changed.
Right.
So that's another thing to look at too.
And you know, it's up to us. You know, you can't say, well, I put it in and I don't. You have to look and make sure that what you did. I mean, maybe Edith, the payroll clerk, said, oh, well, I'll get to that next week, sticks it in a bottom pile, and she never changed it. You got to make sure that what you wanted done is done.
Right.
All right, let's go back to the phones and we'll talk to Dave in Buffalo. Hi, Dave.
Hi, honey. How are you?
Good. What's happening?
I'm a high earner. I range any place between 160 to 200, depending upon the paper it comes to the
Sure.
Now, I'm selling a property that I want to get rid of badly. I got about $1.60 into it, but I purchased it for $90,000. So, can I take a loss and write off the the difference?
You said that you have $160,000 into it, and you're going to sell it for $90,000?
No, if I sell it for less, I just want to get rid
No,
of it.
his cost basis is about $250,000. He bought
Wait.
it for $90,000, put $160,000.
No.
No, that's not what he
what he
said.
said.
What did you say, Dave?
It's a total income of $160. I mean, that I get into it.
No, all right. So your total investment in the property is $160,000.
Yes.
Including
All right.
purchase price.
Including the purchase price, right?
Yes.
And you're going to sell it for how much, Dave?
I don't know. As soon as possible. If I can sell it for 90.
All right. So, all right. So why would you sell it at a bargain sale like that?
Just to get rid of the darn thing.
Okay. Now, has it been rental property?
Yes.
All right. So what happens with rental property is every year you take a systematic write-off of the cost of the asset. So if you have $160,000 into it, how many years have you owned it for?
But I only rented it for a year.
Oh, okay. So it was a personal residence,
It's a personal residence.
and you converted it to rental.
Yes.
At the time you converted it to rental, how much was it worth?
$160. I got the total dollar amount.
All right. So then why would you sell it for $90,000?
It's a personal situation. It's a nightmare.
Okay. So okay, and the property is not deteriorated since last year,
No, not at all.
and you're not selling it to a relative.
No.
Well, he'd be able to take a capital loss.
Yep.
Right? But you can call me. I'll buy it, Dave. I mean, why would I not? I'd pick up $80,000. Why would I not buy your property?
I was told by my by somebody who knows supposedly that I'm precluded from taking that loss as a consequence of my earnings.
No, it'd be a
That would be a
it
rental
would be a
loss.
capital loss. So if you took the property and when you at the time you converted it to business, it was worth the 60, and now you're selling it at a loss, then it would be deductible, but you can only take $3,000 a year until the loss is made up against other capital assets.
Okay,
But this is what I would warn you, is that it looks like you are taking something that was personal and you said it was investment, and so there would be scrutiny from the IRS to make sure that it was investment property because a loss on a personal residence would not be deductible.
Okay.
Hey, I gotta get everyone
All
else
right.
to call.
All right. Hey, look, call me, email me at egtax@hotmail.com, and we can converse over the internet. Okay, Dave?
Will not work. They just broke.
Thank you. I don't know what happened with Dave and the kids and whatever, but anyway, but that's what's important. A loss on a personal residence is not deductible.
Right.
A loss on an investment property is deductible. What you have to say to yourself is, why would somebody take an $80,000 loss?
Right.
And so that's where, it starts to smell like bad fish, right?
Yep.
I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on your cell phone. We got another text.
My dad passed away in 2018. Bank did not do an RMD before changing the IRA to mom's name. Distribution has now been done in March of 2019 for Dad. I asked for a corrected 1099-R, but the bank isn't going to do that. How should this be reported?
So mom didn't do the RMD.
Right.
So she really did take it out the year
Well,
later.
she took it out.
It looks like she took it out in March. So they didn't do it. Looks like dad passed away in 18, didn't do the RMD. Mom took the RMD
Right.
out in 18. And a year later, or in the next tax year. So she's going to have to go to the
5329,
and ask for
page
an
2, and
exception,
ask for an
for
acceptance.
And they almost always do it.
Yep.
I
And
mean,
I
they have-
actually had a similar one this week, exactly like that.
Yeah. So what happens is it's such an emotional time. You got to do the required minimum distribution if you're over the age of 70 and a half. And if you didn't, then there's this penalty that's 50% of the amount that you should have taken out. But there's kind of like a please don't charge me the penalty part on the tax return on the form 5329 on page 2, where it says, please forgive me. I didn't know that my husband died. I was under the stress. And I have to tell you, most of the time they let it go if you got a good excuse. All right, let's go back to the phones. We got Karen and Tonawanda. Hi, Karen.
Hi, guys. I have two questions. My husband snowplows part-time. Can he deduct the mileage, and does that require a separate form?
Yep, well, he would have to do a Schedule C for the business, so he has to claim all his income, and then he can claim all of his expenses. So, yes, the mileage would be part of it, and then he could do his plow. He could do any extra business liability insurance.
Advertising.
Yep.
And he can either take 54.5 cents a mile or the actual expenses that he put on his truck to do the snow plowing, whichever is better. So he needs to do a Schedule C. He reports the income, reduces the income by all of his expenses, and then he pays taxes on the bottom line. And on his bottom line, he can actually do a pension plan called an SEP. That would be another way for him to save money.
But
again, if you need help, you can visit us at our website at egtax.com.
Hold on,
or
and
Karen,
we'll get your
hang on,
other
we'll
call.
talk to you on the other side.
Yep.
Okay? I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone. We'll see you on the other side. Hey, I'm Esther Golias, the tax lady from EG Tax. We want to help you with your taxes. We're going to go back to Karen, who's been so patiently waiting. So, Karen, do you have any questions before we hang up on you so abruptly?
I'm 67, and I get a measly $200 from SSI.
Uh-huh.
The government takes out about $134 of that for
Medicare.
But at the end of the year, I get a statement saying that they've given me like $2,000, which that's not true in a way because I can't spend it. Most of it goes for Medicare.
Well, if you remember when you were working, like let's say you made $10,000, then they took out about $700 in FICA, but they taxed you on the whole $10,000, and the FICA isn't deductible either. That's the same game they play in Social Security with your Medicare payments. You pay taxes on the entire thing up to 85%, but your Medicare portion is you're able to take as a medical expense, but you are paying taxes on it.
Yeah, it's just part of the game.
Yep.
Thank you.
You're welcome, dear. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we have Tom that's waited for a long time. Hey, Tom.
Hey, how are you?
Good. What can we do for you, sir?
A friend of mine is on Social Security disability.
Okay.
She gets approximately $950 a month.
Okay.
That's her only income. She has just gotten divorced from a federal employee, so he has a TSP. Part of the divorce is that she's going to be getting $7,500 out of his pension.
Right.
Now, they want to withhold 20% for taxes. So I know that he has to file a return in order to get those taxes back. Between the $7,500 and her Social Security, do you think she will get the whole refund back, or will she owe something?
Okay, so $7,500 is going to be her total distribution per year from this.
No, it's a one-time charge.
She's getting $7,500, period.
Period.
And she's got Social Security of $950 a month, right?
Approximately, and that's it.
Okay, so she's got 10-8 and she's single, right?
Yes, she is.
She's not going to pay any taxes. They shouldn't withhold anything.
Well, the TSP sent her in the packet that they mandatory withhold 20%.
Okay, well then she's going to get a refund.
She'll get it all back.
Yeah, she'll get it all back. But yes, she'll have to file a tax return.
Okay, that's what I thought. I just wanted to.
You are absolutely correct.
Okay.
Thanks, Tom. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We also have a text up here.
Esther and Chris, my parents signed a rental property over to me and my brother. Just signed it over to us by deed in 2018. How do we depreciate it, or do we? My parents owned it for about 50 years.
Okay, so first of all, assuming that there's been a systematic write-off on the house, which there should have been, there should be a very little basis left for depreciation, because if they've been writing it off all those years, there's nothing left. So it means that the kids who got this gift from mom and dad kind of are left holding the
zero
bag
basis.
because there's a zero basis, and they're not going to be able to, unless dad and mom just did a major remodel the last couple of years, they're going to have a zero basis, so they're not going to have any depreciation. Now, if you got to ask, why did grandma and grandpa,
Mom and dad,
sign over the property to them? Right?
Right.
So if they did it in anticipation of going into a nursing home, there's still a 5-year look back. And so the parents, in the event that the kids want to sell the house with a zero basis, they're going to pay taxes on the whole thing. They might want to think about, I don't know, but they might want to think about giving mom and dad back the property, right?
Yep.
So that, if mom and dad are ill, that the house could come through the estate, and then it would have a stepped up basis. And so if it was worth $100,000, even though it was has a zero basis due to depreciation, upon their death, mom and dad's death, the kids would get it at $100,000 or whatever the fair market value is. And then if they sell it, they would pay no taxes. Otherwise, if the house is worth $100,000, they're going to have $100,000 capital gain. So that's something to think about. I don't know their particulars, but that would be something. Would you agree?
I would agree.
So sometimes you have to say, I don't want it. I'm going to give it back to you, mom and dad. Now, then the problem then becomes, if mom and dad are looking at giving it away because of a nursing home, then, obviously a nursing home at $14,000 a month is a lot more expensive, more costly than paying capital gains. So that's something you have to weigh out. But, just because they gave it to you doesn't mean you want to keep it, give it back to mom and dad.
As long as the house is worth more than, in equity, more than, because there's two people.
Home.
Well, no, 14,000 and 14 if they're both alive. 56,000 because it went to him and his brother. Mom and dad have to do a gift tax return.
That's true.
Which would record it showing the gift, where if it was.
But of course, they wouldn't probably, again, unless they are very
right. But I'm just saying
wealthy.
For the track of a nursing home.
That's true.
How they would catch it.
I'm Esther Gulias, a tax lady from EG Tax. 8030930, 8030930, star 930 on your cell phone. And if you want to text us, 3930 is our texting phone number. And I got Chris Fabian with me. We're from EG Tax. We got 16 days, kids, until the jig is up. And I know there are people out there that owe money and they don't know what to do. And we can help you. As a matter of fact, I think next week that's what we're going to talk about. If you owe money, some of the solutions that there is. Some people just don't want to pay. But if you got the equity and the assets to pay it, you just got to do it.
Right.
Okay, let's go back to the phones. We're going to talk to Lynn. Hi, Lynn.
Hi.
Can we help you?
Yes, I hope. I was just working on my daughter. I usually help her with her taxes every year. This year, I realized when I filed her taxes for her last year that I inadvertently wrote down a health care deduction for her of over $6,000 in payments that she made for health insurance.
Uh-huh.
And I should not have done that, because last year her husband actually got health insurance through his employer, and the payments were coming out pre-tax.
Okay.
I was unaware of that.
All right. So you gave her a Schedule A medical deduction?
I did.
And when you take the floor that has to be applied, she actually had excess?
I'm sorry, what?
So when you take off the 7.5% floor that has to be applied to the medical deduction, she had excess medical that was still deductible?
I don't know.
Yes.
All right. So on the Schedule A, under medical, you take your total medical expenses, of which would have been your daughter's $6,000. Then you have to reduce it by 7.5% of the adjusted gross income. The excess is what's deductible. If your daughter did not get any benefit for that $6,000 because the 7.5% floor was greater than her medical, there's nothing you need to do.
Okay. Okay, but it was because she's self-employed. It was.
Okay, that's a horse of a different color. All right, so
I was confused. Yeah.
So the $6,000 that you said that they paid, that was from her husband's pre-tax contribution at work, correct?
Yeah.
All right, so you have to amend the return.
And you took it as an adjustment on the bottom of page 1 of the 1040.
Correct?
Right.
And
and
amend the return and pay them back the money.
Okay, so is it okay to just go ahead and file the 2018 return?
Yeah. I'm sure they haven't even looked at the 17 return yet. But go ahead and do a 1040X and an IT201X for the state of New York and adjust that accordingly.
Is this something that I could come into you and have you guys do it?
Well, I mean, if you want to, I mean, we're here to serve you. If you want to do it yourself, it's a 1040X and an IT201X.
Okay, great.
All right.
There will be calculated penalties into that. And
well, not
a little
interest. Not so much. It's just going to be interest.
Okay.
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 Thank you, dear.
So much.
Bye-bye. And really, if they're in the 10% bracket, we're talking about $600
right.
in the federal.
15% bracket would be $900.
Right.
So not a lot.
It's not the end of the world, but you want to make sure. It is good when you fix it yourself as opposed to waiting for them to fix it, especially on New York State.
Right.
Because when New York State catches a penalty, mamma mia, right? It's a lot of money, lot of money that they charge you. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone, and our text number is 3930. Right?
Yes.
Chris? And we're going to go to Belle in Buffalo. Hi, Belle.
Hi. How are you?
Good.
Quickie question. He was trying to ask you what the question was, but something doesn't bother me. Anyway, what if you have a parent that passes away, and they have a house, which you are an only child, and the house reverts to you automatically.
Right.
Doesn't have to go to probate because I already had that taken care of, whatever. And they had a lien against your home, and you were paying off the lien, and the lien is due. They gave me a set amount of money to pay back, which I'm going to pay it back, but I'm not going to keep the house. Okay. I've been retired a little over a year, and I do a tax return because I get money back, my pension, Social Security, whatever. And once I pay off the lien, which I haven't done yet, it's a considerable amount of money, but the house isn't worth that much money. But I am selling it, and it's the land where it's located, which I'm not saying where it's located, but it's going to be, whatever. When I file my tax return next year, because I've already did that for this year and stuff, whatever, am I going to have to pay a lot of taxes on the house when I finally sell the house, whatever?
All right, so let's back up, Belle. So your mom and dad left you in their will their house, correct?
Well, the thing of it is my mother's house, and that was my mother.
Okay, so your mom left you her house in your will, right?
And my will or her will? No, she didn't have
her will. In her will, she left you her house.
Yeah, so what's it say? Yeah, because I'm an only child, so it's my house anyway.
Was it a life estate?
No.
She passed away and left you the house.
Well, I just because it's.
Belle.
Was your name on the house?
Was your name on the deed before your mom died?
No.
All right. Then your mom died. Your mom didn't have a life estate, right?
No.
And you got the house?
Yes.
Okay. So at the time of her death, what do you anticipate that the house was worth at the time she died if you were going to sell it?
The house isn't worth that much money. It's where it's located, and then the land's worth.
Okay. If the house is sitting on the land and you got the house, at the time that your mom died, how much do you think that house and land was worth?
It's a lot of money. Trust me.
Belle, just give me a number.
We're going to say it's worth $200,000,
right?
Maybe $100,000.
All right. So the house is worth $100,000. All right. So let's say in 2019 you sell the house and land for $100,000. You have no taxable gain.
Okay.
Because your basis, what they're assuming that you paid for the house, is the fair market value on the date of the death of your parent. So if the house was worth $100,000 and you sell it for $100,000, you have no taxable gain.
That's a twofold question. The thing with it is the lien that she had a lien against, which I am paying off.
That has nothing to do with it. What you asked me was how much would you have to pay in taxes? If the house and land was worth $100,000 and you sell it for $100,000, now there's computations that are going to be in and out. Okay, you have no taxable gain. You may end up with a deductible loss, but for simplicity's sake, if it went through the will that you inherited it, then your basis, it's assumed that you paid for the house, would be the fair market value on the date of the person that gave it to you, plus any expense of sale, plus any expenses that you had to keep it in repair until you sold it. Okay?
Thank you.
You're welcome, dear. Thanks for calling. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone. It's interesting because I was going to talk about gifting. Gifting people assets. If that mom had gifted the house to Belle, and mom paid $10,000 for the house 60 years ago, what would Belle's basis have been?
$10,000.
$10,000. And if Belle sold it for $100,000, Belle would have a $90,000 gain. Right?
Yep.
But if it goes through the will, all right, the estate, then you get a stepped-up basis. It's the fair market value on the date of the death of the donor. So many times it's better, instead of gifting the asset away, it's better to die with the asset.
Yep.
And put it through
Just
the will.
like we were talking about for that texter who got that rental property.
That's exactly right. So giving something away, you give it away because you say, "Oh, I'm afraid I'm going to go into a nursing home." Well, that's a fly of a different color, right? Because there is a 5-year look back, and so that's a yin yang. You don't know. None of us know when the Grim Reaper is going to come to call. So you do the best you can, but that's the way it goes. I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on your cell phone, and our texting number is 3930. And we got Frank here from Lancaster. Hi, Frank.
Hi, good afternoon. I had a question. This year I was on a board and received compensation in the form of cash as a $990, but also in stock. But the stock is restricted. When would I have to recognize the income from the stock?
When you sell it. So right now, you may have gotten, if you got the stock, say the stock was worth $60 a share and you bought it for $50, the $10 difference would be in your income now. And when you sell it...
He's on a board. They gifted him.
Okay.
They gave me the stock.
So it has a zero basis.
Yep.
Right. It has a zero basis. So let's say it was $35 a share or whatever.
Right. So you have a zero basis. So when you get rid of the stock, then it's going to have a zero basis with whatever you sell it for at the time you sell it.
Okay. So I don't have to recognize the income for receiving that stock until I sell it?
Right. Because you're not an employee of the company, right?
He's on the board.
You get a W-2?
No. I get a 10-9. I'm sorry.
Okay, so let's have you email us, Frank, so we can go into the particulars, because I wouldn't want you to be misled, because if it's restricted stock, I want to make sure that we know all the ins, ands, ors, or buts. My email address is egtax@hotmail.com, and then we can get more personal in your situation.
Sure. Okay. And with the cash that I did receive, I would fill that out, and I would put that on.
All right. Does that say non-employee compensation?
Yes, it does.
All right, so that goes on a Schedule C, and you're going to have to pay self-employment taxes on it as well. Right. And you can reduce that by any expenses that you incurred, maybe having to travel to meetings, maybe some, I don't know what expenses you might have had, maybe overnight expenses to go to the board meetings would reduce the overall income you received, so that'll also reduce the FICA.
Okay, I've got that part figured out. I was just having.
So also, can I ask how much it is, Frank? The 1099 portion.
Gosh,
just give me a number.
Oh, about $10,000.
All right, so you can put $22,000 of that into an SEP as well, and that'll also save you some money.
Sure.
Now, the stock value wasn't put in that 1099, was it?
No.
No.
Okay, I just want to make sure.
Yeah. So, but you can also do an SEP that'll save you some more money too.
Right. I did receive dividends on the stock, but no, I did not. The only thing was this: I received the stock, but there's no, it's not. It wasn't in the form of 1099 or any kind.
Okay, so on the 1099, reduce it by any expenses. No expenses, got $10,000 net profit. You're going to pay 15.3% right around an FICA. And you can also put, if you have a qualified pension plan at work, you can also do an SEP outside of your pension plan and save a couple of $1,000 in taxable income. Okay?
Sure.
All right, Frank. Talk to you later. Thanks for calling. I'm Esther Golias, the tax lady from EG Tax. We have 30 area offices to serve you. You know, taxes aren't easy. And the forms that they give you aren't easy to interpret many times, too, right? And there are all kinds of nuances in the law. And I will tell you, if you find out that you owe money this year, there are things you can do. The IRA and the SEP and those kind of pension plans that are still opened up till April the 15th. Actually, SEP can do October the 15th if you file an extension, can really save you money. So you want to make sure that you get that second opinion before you say, oh, well, I owe the money in taxes. Just like this lady that her daughter, she let her husband claim the daughter when her daughter was in college. She didn't even know about the American Opportunity Tax Credit, and it saves her $3,500. There are things in the tax law that can save you money. It's good to have a second look, and EG Tax doesn't charge you for the second look. And so if you want to go into any of our offices, we're happy to help you.
Yep, and tomorrow we are opened at the McKinley Mall. Mall hours, so 11 to 6. So if you need it done on a Sunday, we're there for you there as well.
And the other thing is, we were talking about gifting. It's really important, and I had a gentleman just before I came in. You know, as your parents age and as we all age, it's very important that you don't just willy-nilly go ahead and give away assets. And the other thing is, you really need to come up with, I think, if I'm not here letter. These are where my savings accounts are. These are where my IRAs are. This is what the stock is that I have. Here is where my will is. Because if you don't do that kind of notification, your heirs, in the event of your death, and we all don't know when that's going to be, are left with, where's mom's assets? Where's dad's assets? Did they have this? What did they have? And if they don't know it, what happens is it goes to the state as an unclaimed fund, and that's not what you really wanted to do. And you got to make sure that you got your ducks in a row. And this time of year, when it's not going to be so nice tomorrow, it's a good time to sit down and do that kind of planning. Make sure you got your will together and all that kind of stuff.
You know, make sure mom and dad, make sure you have beneficiaries listed. Make sure you have secondary beneficiaries listed so it doesn't go to an estate.
And I will tell you, if you have IRAs and you don't have your beneficiaries listed on your IRAs, shame on you, because what will happen is instead of giving them all this latitude as to what they could have done upon your death for your IRAs and your annuities, it just goes and it's going to be fully taxable to them, and that would be a terrible thing. Anyway, I ran out of time. I'm Esther Golias, the tax lady. EG Tax wants to help you. Until next week, I'm Esther Golias with Chris Fabian. EG Tax is there to help you. Until next week, bye-bye. Have a great week.